Hello, here we are again. We are getting to the end, aren't we? The end is in sight. Are you guys ready for the semester to be over? No. No, I know, you don't want it to end. Neither do I. So, well, let's go ahead and plunge right in. I only gave you, besides the Chapter 21 Connect assignment that you need to do, I only gave you one homework problem. Is that correct? And that was at the last end of the previous lecture. We talked about notes payable and the sort of notes payable that you might encounter in your real life or in your real business. Okay? So let's go ahead and take a look at that. The auto note payable handout. All right? Okay. On December 31st, 2014, Tim's Landscaping Company decided to buy a new pickup truck for his business. The truck will cost a total amount of $22,000, which will be financed with a 2-year loan. Loan payments will be made monthly, with the first payment due 1 month after purchase date. Using your knowledge of time value money as well as the time value money table in this handout, compute the amount of the monthly payment for each of the following annual interest rates. Treat each case below separately. Okay, so in each one you had to do a P of A problem, right? Okay. Now, if it's an annual rate of 12%, what is the monthly interest rate? 1%, because it's being paid off over 24 months, right? So we go to the P of A table, 1%, 24, and this is the value that we find, right? Okay. So is that a reasonable number for a loan payment? Yeah, I think so. Well, now I ask you to reanalyze the situation if the annual interest rate is only 9%. And I think it would make sense if the interest rate is cheaper that the loan payment is cheaper, right? This is why you want to try to get as low of interest rates as you can in those times when you do have to get a loan, right? Okay. So now with 9% annual rate, that is a monthly rate of what? 0.75%. So I had to make this special table for you because the table in your book only deals with whole numbers up here, right? Okay. So I had to make my own table, 0.75%, 24, there's the value here. But you could not have got this from your textbook, okay? All right, so that's the value that we use right there, all right? And then lastly, I say, what if we have an annual interest rate of 6%? Well, an annual interest rate of 6% is 0.50% interest rate over 24 months. This is the value in the table, again from the second page. And our annual payment is $975.05. Okay, so did you guys get those numbers? Any questions on that? Okay, then what I asked you to do is fill out an amortization table, at least just the first few lines, okay? Now, on 12/31/14, that's the purchase date, right? So we don't have a payment or anything there. I just show the beginning balance of principal, okay? The second and third and the fourth row are 1 month, 2 month, and 3 months from purchase date, right? Now we know that our payment amount is $975.05, correct? So that's how we fill that column. How do we get the amount to interest? Well, we take the monthly interest rate, which again is 0.50%, and if you entered that on your calculator, that would not be 0.5 or 0.05. That would be 0.005, correct? 0.005. But we get this amount by taking 0.005 times this balance right here. So 22,000 times 0.005 is $110. This number here is just that minus that equals that. This number here is 22,000 minus 865.05 equals 21,134.95, right? The logic stays the same on the next row. It is 0.005 times this number, right? Equals that. This number equals that minus that. And this number equals that minus that equals that, right? In the same way with the March 31st. Did you guys get those numbers? Okay. All right. Now, obviously, this principal balance doesn't go to 0 because I only had you do the first few months. This is a 24-month loan, is it not? Okay. Now, if one were to do the complete amortization table, this is what it would look like. Okay. I can't show the whole thing. You won't be able to see it. Okay. There's the, let's see. These are the rows I think that we did. Right here, is that right? Yeah, these are the rows that we did. But it's the same logic going through the whole thing, okay? And I have it go clear to completion of the loan, okay? And you can see that the balance, the ending principal of balance after we make our 24th and final payment is 0. And if we add up all the amounts to principal reduction, then that should equal $22,000, okay? Our payments of $975.05 times 24 equals that, which means this was our total amount of interest that we paid over the course of that loan. Are you with me? Okay. Now, as a bonus video, and you do not have to watch this, for you folks here, you're not responsible for what I'm going to talk about here on this bonus video. But I'm going to put a bonus video out there after this one that teaches you how to make an amortization table using Microsoft Excel, okay? That is a skill that is very, very worthwhile. So you folks who are watching this, who maybe are not enrolled in the class, that'll be right after this. It'll just be a bonus video on creating an amortization table using Excel, okay? So something very handy to do. All right, back to our problem though. This is all I asked you to do, but then I wanted you to use that information to prepare the journal entries for the appropriate dates. Is that correct? So, on the purchase date, you debit truck and you credit notes payable for $22,000. Now, I wasn't as clear as I should have been on this. Did anybody debit cash and credit notes payable? Yeah. I didn't make it clear that if they finance the truck at the truck lot, you know, and so you would finance the truck and they'd give you the truck at the same time, or if you got a loan of $22,000 cash and then a separate transaction, you use that money to purchase the truck. Does this make sense? Okay. So if the loan and the purchase of the truck occurred at the same place at the same time, this would be the journal entry. If you thought of it as getting a loan and then using that money to buy the truck, then you would have had cash here and the notes payable, correct? And then somewhere else in your general ledger, you would have needed to credit cash for $22,000 and debit truck for $22,000, right? But I'm really most concerned with the liability portion of this, so don't worry about that too much. Okay, these journal entries come from this table, right? Our payment is $975 in both of these instances. The amount to interest is $110 and $105.67, $110 and $105.67, and the principal reduction is $865.05 and $869.38. We debit notes payable, thereby reducing notes payable for those amounts, okay? So you need to have an amortization table to be able to make your journal entries, right? You don't use the journal entries to make this, you use this to make these. So a lot of times when I go to my clients and they have to make a monthly journal entry for their loan payment, they have an amortization table in their file so they know exactly how much to put to interest expense versus principal reduction. Questions? Okay, I'll probably have a question or two like that on your final exam, okay? So I want you to know that. Like I said, I know that was kind of separate from everything else, but I wanted you to be aware of that because it is an important subject, okay? All right, let's switch gears, okay? We're going to switch gears now. We're going to start talking about budgeting today, okay? Now, a little word on how I did the PowerPoints here, okay? Now, I have some PowerPoints, and there are only like 9 or 10 of them, and they look like this: master budgets and planning. Okay. Now, in my opinion, the best way to learn budget is to do examples. Okay. So I don't go through a bunch of PowerPoints on budgets. I just don't do that. I think it's very confusing because you can only see a small portion of the budget and the given information at one particular time. Okay. So the PowerPoints that I'll go through for chapter 22 are very, very brief. Now on D2L, I actually do have an appendix, okay, to chapter 22. And this gives individual budget examples if you want, okay? Now, I'm not going to go through these at all, but if you want to have these, those are out there for you to print, okay? But I choose to just look through real homework problems, real examples, and just work through those. You with me? Okay? But be aware that those chapter 22 appendix is on D2L if you'd like to have it. Okay, let's talk about some just general basic budgeting concepts in regards to master budgets and planning, okay? All right, the budget process. Okay, let's say we have a young couple here and they are working on their budget, okay? And what would be some benefits for a young couple to do budgeting for their family? Tell me some reasons, and maybe you do budgeting yourself. What would be some benefits you can come off of that?
Financially.
Okay, perhaps you want to save up for something, like a house or a vacation or something like that. So you want to know where your money's going. Matt, what'd you say?
Financial security, just ease of mind.
Okay, peace of mind, okay? Sometimes you have that unknown out there, and it's better to get it down on paper. Like, do we have enough money to live? Well, let's figure it out, okay? So peace of mind, okay? What else?
Debt management.
Debt management. Maybe you have some debt that you want to pay off, okay? I remember early on in my marriage, my wife and I, we had a decent amount of debt, either auto loans, student loans, and we had some credit card loans. And we didn't know how much we owed, even though we owed a pretty good chunk. Why do you think we didn't know?
Because you didn't budget.
Well,
Ignorance is bliss.
ignorance is bliss. Ignorance is bliss. You ever watch the show The Biggest Loser? And they have these people who weigh like 900 pounds, but they don't even know how much they weigh. And the first thing they do is they weigh them, right? On camera, they weigh them, and they see how much they weigh, and they usually start to cry and everything, right? And they say, I haven't weighed myself for 3 years. Well, why did they not weigh themselves? Because the news was bad. They did not want to know, right? And sometimes we do that in life, okay? It's like, la, 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 I don't, no, right? But it's always better to know than not to know. And when you don't know, Matt, you do have a certain uneasiness that exists, don't you? And so I can remember the first step to getting rid of that debt was my wife and I sitting down and said, okay, we're adults. Let's figure this out. And we wrote down on everything and what we owed, okay? Here's how much we owe on student loans. Here's how much we owe on the car. Here's how much we owe on Visa, credit card. And we finally got it down. And I tell you, and once we saw that number, you know what that number was by chance? This was a number of years ago. It was $26,000, okay? It's not great, but there's a lot sadder stories, okay? That was all of our student debt too, okay? But what we did then is we budgeted a plan to get that thing paid off. And what we did is we actually made a graph, and we graphed out our principal balance, and we watched it go down. And we would have certain rewards. Let's go out, once we get it to 20,000, we're going to go celebrate and have dinner, okay? Once we get it to 10,000, we'll go celebrate. And then, you know, once we got down to 0, it was pretty exhilarating, right? But that was how we did it, is we had a financial plan to do that, okay? And you can see, we just talked about notes payable. You can see how that would dovetail into, budgeting would dovetail into paying off your debt as well, right? Good. What are some other reasons that a couple might do budgeting? They want to know where their money's being spent, right? Okay? But the other reason is whenever my wife, and you can look at that picture again, and let me tell you, for those of you who are married, when you do get together with your spouse and you talk about money, it usually is just as much fun and as this couple seems to be having. It's just, there's lots of laughter and merriment and very romantic time. It's just great to talk about money with your spouse. But in all seriousness, it helps you focus on the future, doesn't it? You know, where do we want to be in 10 years? Where do we want to be when we retire? Do we want to be greeters at Walmart? I'm not retiring in 10 years, but what do we want our life to look like? Can we afford a vacation? Should that be a priority in our life? We have kids. Do we want to take those kids on vacation? Okay. So the same reasons that a couple might do budgeting are the same reasons that a company might do budgeting, looking at the slide. It helps them define their goals and objectives and helps them focus on the future. Helps them communicate with each other as far as what their plans are. Helps them coordinate their activities. And it provides a basis for evaluating performance, okay? Sometimes like, well, are we doing okay? Well, I don't know if you don't have any sort of measurement, right? If you don't have any sort of level of which you're supposed to evaluate yourself against, right? Okay? And the other thing is it can be motivating, okay? You might think, well, how can a budget be motivating? Well, I give you that example of when we paid off our debt. It was motivating to know that we were taking care of this problem, right? And that we could see that balance go down, all right? And, you know, it is motivating. Some of you have been in athletics, right? And you set goals for yourself, right? And if you meet those goals, you have to work hard for those goals. But if you meet those goals, if you run the 5K in the time that you were aiming for, it's motivating, okay? It's motivating. And it can be that way, too, for budgeting. And I want you to read a little bit more about budgets in your textbook as far as some of just the general aspects of it. But that's kind of some of the advantages of doing budgeting, okay? Now, the budget committee. This is managers from all across the organization. And budgeting can be quite a lengthy process, okay? The college here, they spend at least 3 or 4 months a year budgeting for the next year, preparing their budget, and all the different managers get together, okay? Now, the most effective type of budgeting is something called participative budgeting, or a bottom-up process, okay? And that's when you gather information from everybody in the organization to help you as you prepare your budget. Now, the opposite of a bottom-up process would be a top-down approach, where top management just makes the budget for everybody. That's not a good idea, as you'll read about in your book. If people don't have a say in the budget that they create for themselves, they have a built-in excuse for not meeting it. They'll just say, well, hey, you didn't ask me. I'd have told you this was not realistic, okay? And also, these people probably and most likely have better information about a lot of aspects of the business because they're close to it, right? So a bottom-up or participative approach is the best. Now, the budget timing. The most common budget timing is an annual budget. And then you can maybe, if you want, divide it into quarterly or monthly budgets, okay? There's something called a continuous or a rolling budget, okay? This is when you have a 12-month budget that kind of rolls forward, okay? So you can come off that for a second. So like if you have a budget that's 12 months out and you move through a month, you add another month on at the end. You move through a month, you add another month on at the end. So you always have 12 months of budget ahead of you, okay? That's a continuous or a rolling budget, okay? The master budget. The master budget consists of all these different components: operating budgets, capital expenditures budgets, financial budgets, okay? And you know, this is for the very first budget that you need to prepare is always the sales budget, okay? Everything flows from the sales budget. So that's one of the operating budgets. But then you have production or purchases budget. That's another operating budget. You have some others as well. Capital expenditure budget, if you're going to purchase like a big piece of equipment or a building or something like that. Then you've got a lot of selling and administrative budgets as well. And then you can actually do a cash budget, a budgeted income statement, and a budgeted balance sheet, okay? These are all components of the master budget. But know that the sales budget is the first budget that you need to prepare, okay? Everything flows from that, all right? Now, like I said, the remainder of chapter 22 is going to be best learned by doing examples, okay? So we're going to kind of look at some of those and just get to work and do some, okay? Now, this is a chapter that you need to do your homework on, okay? You need to do your homework on. I say that every chapter. You can't learn this stuff just by watching me do this, okay? Now, the first thing I said was, and you can come off the slides there, what was the first budget that we prepare? That's going to be the first one we look at. So what I want to do is look at Quick Study 2210. Quick Study 2210, okay? Let me go ahead and show that up on the camera, okay? Okay, Quick Study 2210, right here. Okay, Grace sells miniature digital cameras for $250 each. 1,000 units were sold in May, and it forecasts 4% growth in unit sales each month. Determine A, the number of camera sales, and B, the dollar amount of camera sales for the month of June, okay? So I'm going to ask you to kind of prepare a little sales budget for this. Now we're actually going to work on this together. We're not going to play the music or anything. Now, I want you to know that what they're asking for is it's not a difficult question, okay? It's not a difficult question, but, and the answer to it is actually, if I just want to know the projected sales for June, then here is your answer right there, okay? The projected sales for June are $260,000, okay? But what I want you to know is this is not a sales budget. This is just computing the projected sales for June. Are you with me? You can come off that. It would be this. There's a difference between if I ask you, what is the net income for the year versus prepare an income statement for the year, right? If I ask you to prepare an income statement in understandable and good form for the year, and you say net income was $180,000, well, that's great, that's the bottom line, but that's not an income statement, is it? Okay? That is just a net income amount. So a large part of budgeting, folks, is not just computing a number, but figuring out a way to present the information in an understandable way. Are you with me? Okay? In a way, you're going to be kind of taking on the role that I have as an instructor. Okay? It's not enough for me just to understand accounting, but I have to, as an instructor, if I want to be a successful instructor, I've got to be able to convey it to you and communicate it to you in an understandable way. Right? Okay? Have you ever had a professor who you sensed was extremely smart? I mean, just brilliant. Maybe they were even a genius, but they were a horrible teacher. Have you ever had a professor like that? And sometimes they get frustrated. They're like, why don't you understand this? It's because we're not geniuses, right? But I had professors at the university who I thought were probably brilliant technicians, but they couldn't communicate it. They didn't know how to say what they were doing. Matter of fact, the best teachers that I had at college were probably instructors who struggled a bit because they had to figure out a way to do it. Does that make sense? Okay? So as you prepare budgets, you're not just computing a number. You're communicating how you got that number so that if somebody picks it up, they will understand it. Now, the way you do it versus the way you do it versus the way I do it might look a little different, just like your income statement might differ from yours, which might differ from mine. but the basic information should be somewhat the same. Okay? Now let's take a look at this again, and I'll give you an example. Okay, looking again at this real quick. Let me read through that again real quick because it's been a while since we read it. The miniature cameras sell for $250 each. 1,000 units were sold in May. It forecasts 4% growth in unit sales each month. Determine the number of camera sales and the dollar amount of camera sales for the month of June. I would even add on, just prepare a sales budget for June. Now I'll show you the answer, and you can see the difference between just giving the bottom line versus preparing a budget. Okay? Well, this is for the company, Grace. This is their sales budget for the month ended June 30th. Okay, the prior month's unit sales were 1,000. They predict 40% growth in unit sales. So I said that wrong. They project 4% growth in unit sales. 4% of 1,000 is 40. So the projected June sales are 1,040, right? The selling price per unit is $250. Thus, the projected sales for June are $260,000. Are you with me? That's a sales budget. And the nice thing about this is, let's say I said, well, what would our projected sales for June be if the selling price for unit was $275 a unit? Well, that would be very easy for somebody to tweak this budget and to know what the resulting projected sales for June would be, right? That would not be possible if I just said, here's your sales. Well, what if the price changes? Well, let me get back to you, right? No, but if they have a sales budget prepared in good form, then they can alter these things. Or what if the percentage growth rate is different? Are you with me? But this is conveying that information in an understandable form that people can understand. That if somebody beside yourself picks up, they can see not only are the projected sales for June 260,000, but this is how you arrived at that. Okay? Questions? All right. Okay, let's switch gears here a little bit. You can come off that. We're going to switch gears a little bit, and I want to talk about a process that you will use in budgeting. Okay, now this is not in your book, so I want you to pay close attention. Let's take a look at Quick Study 22.8. Quick Study 22.8. Okay? Now let me zoom in on that a little bit in case you didn't bring your book. Because I'm going to use Quick Study 22.8 as a way to demonstrate this methodology. Okay? Let's read it. Forrest Company manufactures watches and has a JIT policy. What does JIT stand for? Just in time. It's an inventory policy. They have a just-in-time inventory policy that ending inventory must equal 10% of the next month's sales. Okay? It estimates that October's actual ending inventory will consist of 40,000 watches. November and December sales are estimated to be 400,000 and 350,000 watches respectively. So 400,000 for November, 350,000 for December. Compute the number of watches to be produced that would appear on the company's production budget for the month of November. Okay, that is the task at hand. Okay, now let's walk through this. We have used a relationship in this class a lot where we say the beginning of something plus what comes in minus what goes out equals the end of something. Haven't we done that a number of times? Okay? Well, whenever I see verbiage like the ending inventory should equal 10% of the next month's sales, and they tell us the beginning inventory and all this sort of stuff, I know that we need to do what I'm going to show you right now. Okay? So follow this process. The beginning plus what comes in minus what goes out equals the end. Now what I want to do is define these terms for this specific problem that we're doing at hand. Okay? Does anybody know where I'm getting at? Does anybody know what beginning is in this example? Well, no, I'm not asking even for the numbers. I'm just asking for the term.
Beginning inventory of watches.
Very good, Matt. Matt said it's the beginning inventory of watches. That's exactly what it is, the beginning inventory of watches. Okay? What makes us have more inventory of watches?
Manufacturing them.
Manufacturing or producing. Take a look at this again. What makes us increase our inventory of watches? When we produce or manufacture more watches, right? So this term for this specific problem we're doing is plus production of watches. You see what we're doing here, folks? Okay, what makes our inventory of watches decrease?
Selling them.
Sales of watches. So minus sales of watches, and that equals the ending inventory of watches. Are you with me? The beginning inventory watches plus the production of watches minus the sales of watches equals the ending inventory of watches. You with me? Okay, so I do this, then I do this. Then the next step that I like to do is take this equation and write it horizontally. I take this equation and write it horizontally, and I'll abbreviate here. So beginning inventory plus P for production minus S for sales equals the ending inventory. Is that correct? You with me? Now the next thing that I do is I see what are they asking us to do. Take a look at Quick Study 22.8. What type of budget are they asking us to prepare?
Production budget.
They're asking us to do a production budget. So then what I do is I circle the variable that they're asking us to do. They're asking us to do a production budget. The next step is I rewrite this equation, but I want to isolate the variable that they're asking us to prepare for. They're asking us to do a production budget, P. So let's rewrite this so that P is all by itself on that side of the equation. Does that make sense? And this is just algebraically. What do you do? Well, that would be ending inventory, add sales to both sides, plus sales minus beginning inventory. Is that correct?
Yep.
You following me? Good. Okay, now the next step is to take this equation that we derived and flip it back vertically with that item right there on the bottom. Are you with me? Take this equation and flip it back so it is vertical. So what I'm going to say is ending inventory plus budgeted sales minus beginning inventory that equals units to be produced. Does that make sense? That is our budget. Ending inventory plus sales minus beginning inventory equals the units to be produced. Now let's define it for this specific problem. What's the name of this company?
Forest.
Forest Company. This is a production budget. And what month is this for?
November.
For month ended what?
November.
You tell me.
November. And
November. November 30. Okay, so title this up just like you would a financial statement. Okay. Okay, what is the ending inventory in this instance? Well, we're doing the month of November, correct? We're doing the month of November. And what they tell us in the problem is that ending inventory should be 10% of the next month's sales. Okay, first of all, we need to recognize this. The ending inventory for, say, well, the ending inventory for 1 month is the beginning inventory of the next month. Is that correct? Actually, we'll use that more when we come down here, okay? But so I'll repeat that in a few minutes here. But the ending inventory for November should be what? It should be 10% of the next month's sales. Is that correct? So what is the next month's sales?
350,000 watches.
350,000 watches.
It's 400,000.
What?
Is
that
it
correct?
for November?
Well,
You need the sales for December.
it's for the 10% of the next month's. So this is December's sales. Is that correct?
Yep.
So that's the next month's. So it's 10% of the next month's. We're doing November, so we need to do 10% of December's sales. So what's 10% of 350,000 watches?
35,000.
It's 35,000? Is that right? I could say units or watches, okay? Plus budgeted sales for November. What's the budgeted sales for the month?
400,000.
Units or watches. Minus the beginning inventory. Now, this is where what I was saying should really have been stated. It's important for us to know that November's beginning inventory was October's ending inventory, correct? November's beginning inventory would be October's ending inventory. And October's ending inventory should have been 10% of November's sales, correct? October's ending inventory should be 10% of the next month's sales, which is November. So it should be, this should be 40,000 units. Do you see that? Because October's ending inventory should have been 10% of November's sales, which is 400,000. 10% of 400,000 is 40,000. So now we can compute the units to be produced. What is that, 395,000? Units or watches. And that is our production budget. Okay? This is not a production budget. That's just computing units to be produced. This is a production budget. Make sense, guys? But do you see how we walked through the process of deriving that budget? People go, Krug, how do you memorize all these budgets? I don't memorize them. I just derive them using this initial relationship, which I see over and over and over again, okay? But that's the budget that I derived for that quick study 22-8. Cool? All right? Now, if you look at what the book did, theirs looks a little different, okay? That's what they did. And you can kind of see it. See if I can put both of these on there at the same time. Not really, but theirs pretty much, theirs looks a little different. They do that 10% times 350,000. They do it up top. but then they have their 35 plus 400. They did a subtotal, which I didn't do. That's okay. But then they subtracted the 40 to get the 395. So theirs is basically the same. The question I have is this understandable? Could somebody pick this up and understand how we arrived at this number? Yes, they could. Cool? Okay, questions on that? All right, I know it's a lot of me talking today, and I apologize for that, but this is just one of those lectures, okay? I found over the years that this is the best way to teach budgeting, okay? Is for me to do some examples. Now, the other thing, you can come off that. The other thing that I would advise, folks, is when you do a budget for homework, take a look in your textbook at the section where it talks about that particular budget. Read through it and kind of look at the example that they give you as well. That'll give you some guidance too. Okay? We're going to talk about one more thing today, and that is about a cash receipts budget. A cash receipts budget. And what I want to use in this, for this example, is Quick Study 2215. Okay? Hang with me. We've got about 10 more minutes. Okay? But this will help you a lot when you do your homework. Quick Study 2215, right here. Okay? Okay, Wells Company reports the following sales forecast. September, $55,000, October, $66,000, and November, $80,000. All sales are on account. Collection of credit sales are received as follows. 20% in the month of sale, 70% in the first month after the sale, and 10% in the second month after the sale. You understand what they're saying here? Yeah. When they make a sale, that doesn't necessarily mean the receivable all comes in that month. Historically, what they found is 20% comes in the month of sale, 70% in the first month after the sale, and 10% in the second month after the sale. Prepare a schedule of cash receipts for November. Okay? Now, it is important to notice that all sales are on account. Okay? So what we're going to do is as follows. They say the collection pattern is 20%, 70%, 10%. Is that correct? Okay, so for example, September had sales of how much?
55,000.
So September had sales of 55,000. So the collection pattern is going to be 20%, 70%, 10%. Is that correct? 20% will come in September. 70% will come in October, the month after September, and 10% will come in the second month after September, which is November. Let me say that again. I might have said that wrong. 20% of September sales will come in September. 70% will come in October, which is the month after September. And 10% will come in the second month after September, which is November. You with me? Now, what about October sales? How much were sales for October?
66,000.
66,000. So it's going to be the same collection pattern. 20%, 70%, 10%. 20% will come in October, which is that month. 70% will come in November. And 10% will come in December. Is that correct? Let's do this one more time for November. How much was November's sales?
80,000.
80,000 exactly?
Yeah.
Okay, it'll be the same collection pattern. 20%, 70%, 10%, right? Correct?
Yeah.
20% will come in November. 70% will come in December. And 10% will come in January, right? Now, what are they specifically asking us to prepare in this quick study?
Cash receipts.
A what?
cash receipt.
A cash receipt for what month?
November.
For November. They want us to prepare a schedule of cash receipts for November. So I'm a very visual person. I always kind of have to write this out. And then what I do is I look for November. Okay? So the cash receipts in November will be 10% of September sales of 55,000, 70% of October sales of 66,000, and 20% of November sales of 80,000. That's what will come in November. Do you agree? Okay. So once we figure that out, you can see what they came up with. Wells Company, there is their cash receipts budget. Okay? They do it in the different order. They do 20% of November sales of 20,000, 20% of November sales of 80,000. Let me say that again. Cash receipts from November is 20% of November sales, 20% of November sales of 80,000. Collection of October sales is 70% of 66,000, 70% of 66,000. That equals 46.2. And then also coming in November will be 10% of September sales. 10% of September sales of 55,000 equals 5,500. That equals your total cash receipts, which are 67,700. But do you see how I utilize this information to make this budget? Understand? Okay. Now, maybe you're smarter than I am and you don't need to do this. Okay. I always get it mixed up. I have a tendency to get it backwards. So I found it easier if I just jot it down real quick. Okay. But this right here is something that somebody can understand. You're not just saying, well, our cash receipts are 67,700. No, that's going to be this collection pattern. Okay? You with me? All right. Any questions on that, folks? Any questions? Okay. Well, let's call it a day. And let me give you your homework. All right? Take a look right here. Here's the homework that I want you to do for next time. I want you to do these quick studies. I want you to do quick study 22.1, 22.2, 22.4, 22.23. But I also want you to do this handout, the Down Under and Sarandon Company budget examples. And there's one up top and one down below. So do that whole sheet and do these quick studies. A lot of these quick studies will be real fast. So have that ready for next time. Again, guys, I'm sorry for the whole lecture of me talking and you not doing anything. I try to make them so there's not a whole lot of lectures like that, but unfortunately this was one of them. Next few lectures we'll be working on some stuff in class. Okay? All right, do your homework. We'll see you guys later. Bye-bye.